This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news about money. And we have a very, very special show today, as all of our shows are. But as an old saying, may you live in interesting times. It can't get more interesting than this right now. I mean, I've never seen it so screwed up. 25 years ago, when Kim and I published Rich Dad, Poor Dad, we knew it was going to get bad, but I didn't think it was going to get this bad. And we've done other things along this whole line. For those of you who know, this is my other book here. It's Who Stole My Pension? And it's written by myself and Edward Siddell. And my concern as an old guy is that my generation, a baby boom generation, is the first, I think it's the first, but it's one of the few generations, well, the first generation with a defined contribution pension plan versus a defined benefit pension plan. There's very big differences just being a C and a B, whatever the thing is. But what happened was in my father's generation, they had a pension for life. So if let's say they worked for Ford Motor Company, they got a pension for life. But when the baby boomers came along, they said it was too expensive and we couldn't compete with China and Japan and Europe. So they took away the defined benefit pension plan, which is what our World War II generation had. And in 1974, they shifted it to the defined contribution. So suddenly most baby boomers have defined contribution, a 401k, IRAs, and things like this. My concern is, right, the reason I say it's interesting times, we're in a massive stock market bubble, real estate bubble, bond market bubble. Everything is in a bubble, and the average baby boomer in my generation has not an effing clue what that means. And that means the reason we wrote this book here with Who Stole My Pension is that many of the people who think they're safe, like the airline pilots and UPS drivers and all these guys, well, Wall Street's been stealing their pensions. And so that's why Kim and I do not have a pension. We just don't want one. And we don't need one. But that's what the Rich Dad Company stands for. Yet, as Kim will attest to, our job is to educate, not to pontificate. So we're going to be talking about what's called a self-directed IRA. Just know this, that we don't endorse it. We don't have one, but you need to know about them, especially being in interesting times. Any comments there, Kim?
Yeah, well, this will be interesting because self-directed IRAs is not something of our forte, but it is a good vehicle for a lot of people. So we want to bring that education to people who can use it and can benefit from it. And that's why we have John Bowens and Jeff Desich. Did I pronounce that correctly?
You did.
John Desich of Equity Trust. And we also have Tom Wheelwright, our tax expert, because he can help translate for us what Jeff and John are going to be talking about. So welcome all to the show. Appreciate it.
Thank you.
Thank you for having us.
Well, let's talk to Tom. Tom, what is the benefit of an IRA or self-directed, real quickly from a tax? I mean, Tom is a CPA. He wrote the book, Tax-Free Wealth. He's my A student guy I go to. So what is a self-directed IRA? What does that mean to you as an accountant?
Well, so basically what it means is that it's an IRA that instead of turning your money over to somebody else, you get to control the investments. So you get to say, I want to invest in this, I want to invest in that. You don't have a mutual fund company like Fidelity, for example, saying, here's what you have to invest in. So you have a lot more freedom with it, also brings a lot more responsibility with it. There are certain investments that make a lot of sense, frankly, in an IRA because you want to postpone the tax on them as long as you can. And there are other investments like real estate that don't make nearly as much sense in an IRA. So it really depends on what you're putting into, what type of investment you're doing as to whether an IRA makes sense or not.
Why doesn't real estate make sense in a self-directed IRA?
Because real estate's a tax shelter.
Yeah.
and you're putting a tax shelter inside another tax shelter, and you actually create taxable income by putting real estate into an IRA. So we don't normally ever, we really never see that. And so we typically look at things like, if you're investing in the stock market, if you're investing in bonds, interest rate vehicles, even gold and silver can be very good in a self-directed IRA.
Good. Okay, we're not endorsing anything here, but the reason Kim and I don't have pensions, and we don't even have any stocks, because I've taken
very little.
Well, mining stocks. I took 3 companies public, and once I understood how they take companies public, like they say, if you saw how they made sausage, you wouldn't eat it. And every time I saw how we took a company public, I definitely don't want a stock. So that's just our personal viewpoint, and that's where the Rich Dad Company is more. We're self-direct your own education, because our schools will never teach us this.
So Jeff, let's talk to you. Your dad started this company?
He did. He started the predecessor in 1974 and really stumbled upon the kind of concept of a self-directed IRA right around 1980. He was a typical plain vanilla stockbroker in our small little town and decided to branch off into real estate and put together his first limited partnership, where he brought in local investors and had the idea of using their IRAs to each put in their annual contributions for 2 years and put together a real estate vehicle. And from that first deal that he did, one of the investors asked if he could buy property himself in an IRA, and that kind of started the process of providing that service. And today we don't offer any investments or anything like that, but we have hundreds of thousands of customers across the country. We're nearing $40 billion in assets. And, I would politely disagree with Tom. Real estate is one of our largest categories. In a given year, our customers will buy and sell 14,000 pieces of property. And yes, with real estate, when you're purchasing it outside of an IRA, you get this great thing called depreciation. But depreciation is, if you think about it, really an artificial benefit. I mean, if you're in an environment where there are no taxes, then depreciation really doesn't matter. And what we really like to really frame up the account, because I like to think as an investor versus an academic. And I look at these accounts really as a vehicle to be able to make investments in a tax-deferred or tax-free environment. So when I'm buying real estate, when I'm buying precious metals, when I'm buying notes, all of that income comes back into my account without the hindrance of tax. And then when I take that money out down the road, I'm going to be able to take that money out tax-free.
Okay, and that's why we have Tom on board here, because we don't have any of that stuff, and Tom is our guide on this whole thing. So Kim and I would say we're pretty sophisticated investors. I mean, to take 3 companies public, we got to know something.
Certainly.
And so I stay away from anything, unless Tom blesses it for us. So Tom, what is your counterpoint on what he just said about?
Yeah. So first of all, in order for it not to be taxed at all, presumably you're talking about a Roth IRA. You're not talking about a regular IRA. Okay. Correct. In a regular IRA, you are actually taking what I consider a tax-free asset, real estate, and putting it into a vehicle that makes it taxable. Yes, down the road, but you're still making it taxable, which it would never, the way we do tax planning, you would never pay tax on that money.
Yeah, so it depends upon you. On the cash flow board game, there's a rat race and there's the fast track. We're fast track people.
Right.
But that means we have to invest in our own financial education. And that's why, Kim and we have a Rich Dad advisor team. So John, it's John, right?
Yes, you got it.
Yeah, John and Jeff. I highly recommend people talk to you, but also talk to people like Tom. And that's the business we're in. We're an education company. We're not a recommendation company.
So Tom, you were talking about a Roth IRA. What is?
Yeah. So a Roth IRA is different because you don't get a tax deduction going in and you don't pay tax coming out. So if you were going to do real estate in an IRA, you would want to do it in a Roth IRA by definition. If you want to maximize your leverage or your debt on your real estate, then that is a challenge in an IRA because it cannot be recourse debt. In other words, you can't be personally liable on that debt, else that's called a prohibited transaction and your IRA is done. So what you have to do is you just have to recognize the limitations that there are and that you do not get the depreciation. Okay, so it's really those two things. It's leverage and depreciation that you lose in the Roth IRA.
Yeah, the whole point here is, ladies and gentlemen, I'm glad you guys are listening to the program. I'm glad to have Jeff and John on because this is what we are, an education company. But to me, the big thing is, are you going to be an active investor or passive? If you're passive and you really don't want to do all the study we do, then Jeff and John are probably pretty good, right, Tom?
No, I agree. So, for example, where I see people investing in a Roth IRA, for example, a self-directed is, say, a doctor who doesn't have any time, doesn't want to get any education, but wants to invest, say, into syndication, right? A syndicated deal. Then they might do that within an IRA because they don't, for whatever reason, their accountant hasn't figured out how that they could get the depreciation. And so they've decided, well, that's not important to them. If the tax benefits are important, then that's a challenge within an IRA because you lose that benefit. If the taxes are not important to you, if the tax benefits of depreciation are not important to you, then you do it in an IRA? You absolutely can. I don't, but that doesn't mean you can't do it.
There's one more thing about being professional investors, this thing called management. And most people suck at management. That's why they're employees or self-employed. So you've really got to be proactive in this whole thing. I was just down in Bisbee, Arizona, managing our property. It takes a lot of time, right?
It does. And
so everyone's going to pro and a con. So that's really, I'm going to establish that up front. That's why I asked Tom to be on here.
And that's exactly what I wanted to go to John with. So John, because you do educate people about Roth IRAs, self-directed IRAs, all of that. What do you see as the biggest pros and cons in the?
Yeah, absolutely. I appreciate it. And certainly I appreciate the healthy debate here between owning real estate inside of an IRA and inside of an IRA. And one of the things that you'll learn as an educator, John, as the head of education here, I'm also an active real estate investor. Right. And my wife and I own real estate inside and outside of a self-directed IRA. So every time we approach a real estate opportunity, it could be an actual property, it could be a real estate partnership, it could be a private loan secured by real estate. So one of the things that my wife and I do quite a bit of is we find borrowers, we find real estate flippers that need financing, and they don't want to go to the hard money loan folks. They don't want to pay the higher interest rates. So they come to private money lenders like us. And when we see those types of opportunities, those are great opportunities for our self-directed traditional IRAs and our self-directed Roth IRAs. Because see, here's the deal. When you make a loan with your non-IRA money, all of the interest income is tax exempt in that retirement plan. If I make a loan without my self-directed IRA, then I'm going to pay ordinary income taxes on that profit. But if I use my self-directed traditional, even better, my self-directed Roth IRA, all of that profit is tax-free. So my philosophy and the way that I coach and educate investors is don't be thinking about doing every single deal inside of your self-directed IRA. You want to be thinking about how you can do deals inside and outside of your self-directed IRA. The key here is for folks that have IRAs and 401ks and other retirement plans, and they're tired of the limited options where they can only invest in the traditional financial markets. And the timing couldn't be better for this podcast, because when we look at the S&P 500 at the time of recording, we're down about 17%. So there are hundreds of investors that are reaching out to us on a daily basis that are looking for an escape hatch. They're looking for a way to invest in Main Street instead of Wall Street. And there are plenty of options across real estate, whether it's private loans or it's actually owning physical real estate. Specific to owning physical real estate with a self-directed IRA, there's a right way to do it and there's a wrong way to do it. And that's one of the things that we do here at Equity Trust is we educate folks on the things that you can do with a self-directed IRA and how to do them effectively, and the things that you want to make sure you stay away from. And that's exactly what Tom was speaking to. So
Jeff, I want to go to Jeff's, because it's getting all about real estate, and it's a good, healthy debate. I like that. But there's also other things like gold and silver. Are those, does that make sense to put that into an IRA? I'd like to hear from Jeff and from Tom.
Sure. I would just echo what John just said. You know, the real power of these accounts is the flexibility. And Robert, you made a really good point. If you're going to be an active investor, you certainly, or manager, you need to be involved. And if you're going to take a passive route, you can go that way as well with one of these accounts. So precious metals, gold and platinum, silver is something that's very, very popular. We open up tens of thousands of accounts a year and hold billions and billions and billions of dollars in precious metals, where people are using that avenue with their self-directed IRA.
Yeah.
Are you also a storage facility?
Yeah.
Excuse me?
Are you also a storage facility?
Well, I actually store it in my basement, but don't tell anybody.
Okay, so
we use a couple of different places where you can store the metals, and the client can choose where among our options they want to be.
Okay, once again, this is Robert Kiyosaki, the Rich Dad Radio Show. Where my rich dad often said there's a million ways to go to financial heaven and a billion ways to go to financial hell. And that's why we're having this Rich Dad Radio Show today. I'm glad you guys are on board. And it really depends upon you as the investor. Who do you listen to? Who do you talk to? So that's why we're happy you're all listening into this one, because there's so many different people offering different services. And if you don't know the difference, they all look the same. So we come back, we'll be continuing on with this whole program. Tom might have to leave.
Tom's got some words to a counterpoint. Go ahead, Tom.
Go ahead, Tom.
So two things. First of all, to John's point, when I talk about not putting real estate to an IRA, I'm talking about the actual investment in real estate, not a loan. So I agree with you, John, that a loan, if you're lending money inside an IRA, that's a great place to hold those loans. If that's part of your investment track, that totally makes sense from a tax standpoint. So I totally agree with you, John. On gold and silver, precious metals, the big concern right now is you actually, if you store it in your basement, you've got under a recent court case, you have a problem. Okay, so you cannot store it in your basement anymore, which I think might have been why Robert's asking, where are you storing it? I probably wouldn't
announce it.
Jeff, I probably wouldn't announce that to the IRS.
So what is the ruling on storing gold and silver?
The rule is you can't have control over it. So you can't store it at your home. You can't store it under your mattress. You can't put it there. That was the recent court ruling. They were very clear on it, and it caused a big problem for this IRA investor. Yeah. And so you have to have an outside, basically manager, storage facility, someplace where you don't have ready access to it.
Where you don't
That's a great point. And I should mention that as a self-directed IRA custodian, we have $3.51 billion in precious metals under custody. And no, it's not in Jeff's basement. These are held at licensed and bonded warehouses, very secure facilities. You'll see some big brand names out there. And so Equity Trust, what we've done is we've built the entire ecosystem for folks that want to use their IRAs to invest in precious metals. So from identifying a dealer they can purchase from to actually storing the physical metals. We do not allow customers to utilize what's called a checkbook LLC IRA, which is exactly what Tom was talking about. That's the McNulty case, November of 2021. Yep. Really glad you brought that up, Tom. We are absolutely on the same page in terms of not allowing investors to take advantage of potential loopholes, because you saw exactly what happened in the case of McNulty. They tried to use a loophole and they ended up creating a prohibited transaction. And that goes back to, our philosophy here at Equity Trust and providing good education and information to investors so that they can make informed decisions, whether it's real estate, precious metals, private lending, investments in private placements, digital currency. There's all types of alternative investments that folks can participate in. It goes beyond just the traditional financial markets. And that's really what we're all about, is helping investors, to Jeff's point, take more control of their retirement savings and be able to invest in asset classes that they know, like, and trust.
Good. So Tom needs to leave. So I want to get Tom in as much as possible. Again, we're not pumping equity trust and all that. I'm glad you guys are here. I'm glad you're here to educate. Our primary job at Rich is make people aware you have options out there. Any other comments, Tom, on what's going on?
Yeah, just final. I'm glad that I'm glad you guys don't use checkbook IRAs. I really don't like checkbook IRAs. The problem with that is that it's too easy to make a mistake. And so you want to you do want to make sure that your custodian, which is, has all their I's dotted and their T's crossed, because with a checkbook IRA, I think you can make a lot of mistakes, and it's really easy to basically blow up your IRA. I think there are sometimes very clearly when an IRA, using IRA for a certain type of investment makes sense. I think the key is understand when you should be, what type of investments work well in an IRA and what type of investments don't work well in an IRA.
What is a checkbook IRA? Because a
checkbook IRA basically is you actually have you'd have a limited liability company that you're the manager of, that limited liability company that is owned by your IRA. So the owner of your LLC is the IRA, but you get to write checks on that LLC's bank account. Well, that means that you end up with too much control. It's not that they're illegal. It's that it's really easy to make a mistake.
Thank you.
So Tom, as people are looking at IRAs and working with different companies, give me one or two questions that are important for people to ask.
Oh, I would ask them, how do you feel about checkbook IRAs? I think that's a very important one.
Okay, good.
I would just add that we're one of the few firms that have really stood strong on this for 15 years.
That is important, because there are a lot that promote it, and I don't like that. I think the other one is, help me understand, what type of investments work, what type don't, and I would also make sure that you're talking to your tax advisor. So don't be talking to one person without the other. Always make sure your tax advisor is involved, because they are working for you. They're only working for you. And they're the ones that you really need to rely on. And then they can talk to Equity Trust as well. So just like you have me to interpret things for you, that's what every person should do, is use their tax advisor as that person to interpret, okay, what are they saying?
Thank you.
Thanks.
So again, one of the problems is, as you guys know, there's 60% of Americans don't have $1,000 to their name. And they don't have a tax advisor either. So that's why I have the Rich Dad Radio Show. So Tom, thank you very much. And then we'll come back. We'll be completing with Jeff and John, and we'll find out more what they do and why you should do what you do. So anyway, thank you, Tom.
Thank you, Tom.
We'll be right back.
What would you do if someone handed you $100,000 right now? Trick question, nobody knows. That's why people are sitting on more cash now than in the past 20 years, according to Bank of America. And with every major index headed to bear territory and the crypto market losing $1 trillion, the Wall Street Journal says the options are shrinking. But that doesn't mean that they're not out there. Because get this, Bloomberg recently asked some financial experts the same question, and they overwhelmingly recommended this particular safe haven asset. It's outpaced the S&P 500 for the last 25 years by a whopping 164%, and has the lowest correlation to public equities of nearly any asset class. The market for this asset remains strong even during the inflationary period of the 70s, the 2008 crash, and COVID shutdowns. And for the first time, it's available to retail investors thanks to Masterworks. Although the demand is through the roof, so there is a wait list, but our listeners get a skip ahead at masterworks.art/richdad. That's masterworks.art/richdad. See important Regulation A disclosures at masterworks.io/CD.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. Again, this is the second part of the show. I thank Tom Wheelwright for his contribution. If you missed Tom's part, please go back and listen to it. All of our programs are archived at richdadradio.com. We archive them because we believe in repetition. You listen to this program a second and third time, you'll learn even more. But more importantly, if you have friends, family members, or idiots in your group, have them watch this show, and then they might learn something. because these are very, very interesting times. I mean, Kim will testify for this. 25 years ago, we started the Rich Dad Company because we knew it was going to get strange, but we never thought it would get this strange. And so that's why you need more professional advice, not least. So our guests today are, Kim?
Guests today are Jeff Bowens, Retail Sales Manager and National Educator of Equity Trust, and Jeff Desich, who is Executive Vice President. And we're talking about self-directed and Roth IRAs and the good, the bad, the ugly. So let's talk about.
And they come very highly recommended from our friends at Lair Capital.
Yes, they do.
So I don't get paid by Lair Capital. I just sing the song about precious metals, gold and silver. And the reason I do that is I've never trusted stocks. And because I've taken 3 companies public, I will never touch those things. Don't touch them. I have mining shares. And a lot of the stocks are stocks I have created. But I really don't trust the stock market. So that's why we're an educational company. We don't endorse. So I'm going to ask the gentleman from Equity Trust to give us the stupid mistakes that people make.
Yeah, I'll jump in first, and then Jeff, you can follow up on some of your observations over the 20 plus years. The first mistake that I see investors make is where they entrust a third party, someone that they're investing in, and that could be through a private loan. It could be through an equity interest in that individual's privately held company, because as we know, a self-directed IRA, you can invest in privately held companies, you can do promissory notes, mortgage notes, trust deeds, so call it debt instruments. And so it's an individual not doing their due diligence. And so a custodian isn't going to do that due diligence. It's up to the investor to make decisions and make sure that they're investing with a reputable party, and the underlying asset that loan or that investment is secured by is safe and sound and is an asset that they feel comfortable with. So that would be the first mistake. The second mistake.
Let me ask this question here. Mm-hmm. When a person has a self-directed IRA or whatever they are, they're kind of acting like their own personal Warren Buffett. Is that what you're saying?
That's correct. You could also say that they become their own financial advisor.
Right.
They're not the mercy of a third party. They're making all the decisions, calling all the shots.
That's a very good point. Very, very good point. It
is a good point, because are you saying, so do some IRA companies actually give advice and give due diligence or?
Yeah. So there are, your traditional brokerage houses, wirehouses, your advisory firms are absolutely going to give advice with respect to where to invest the IRA and 401k and other retirement plan funds. Now, in most cases, in those circumstances, as a fiduciary to that individual, they're only going to recommend traditional stock market-based assets. So that's why our customers come to a directed custodian, is because they acknowledge that the directed custodian isn't going to give them financial advice. But because they're not giving them financial advice, that opens up the opportunity to be able to self-direct into all of these non-stock market-based alternative investment opportunities.
Right. So they play Warren Buffett.
That's correct.
Okay. I'd like to keep things simple here at Rich Dad, because I'm a simple guy.
Yep, absolutely. The second mistake that I see folks make is they attempt to make investments that are what are considered prohibited transactions. So for example, if I personally own a property, I can't take my IRA money and buy that property. If I have a mortgage on my primary residence, I can't use my IRA money to bail myself out of that mortgage. So that's an example, one example of a few that are called prohibited transactions. The idea is you want to be using your IRA funds for their intended purposes. Like I always like to say, IRAs and retirement plans have highly powerful tax advantages. And I like to say compounding interest in the absence of taxation. So if you're utilizing these self-directed IRAs properly, there's a tremendous amount of benefit in the long term because of the compounding interest without taxation. But with that, you have to make sure you select investments and you're self-directing your retirement funds into assets that you're not personally a part of. That's the best way to think of it. You want your IRAs and your retirement plan investments to be totally separate from your non-IRA investments.
Thank you. Very good point. And next point, anything else?
Jeff, anything you have in terms of mistakes that people make with IRAs?
Sure. I think one of the one that we see, and we see less of now because more clients are utilizing the Roth IRA, but looking at making investments in a traditional IRA where you have the tax deferral and you'll pay tax later in life. If you have the opportunity to take advantage of the Roth, it'll put you in that position where you won't have taxes, assuming you make your qualified distributions going forward. And Robert, I know you talk a lot about inflation. We talk a lot about the government printing money all over the place, and someone has to pay it back at some point. So I'm going to go on a limb and assume that as we go forward, taxes are only going to go up. And being in an environment where you're overtaxed and it's eating into your profits and into your retire or your savings, being able to eliminate taxes from the equation or at least reduce them dramatically is a major catalyst to finding financial freedom. And that's what we're talking about here.
Okay, but you're getting into a promotion. It's one of the mistakes that people make. I mean, any idiot knows you don't want to pay tax, and inflation is a tax. So what mistakes do people who have no idea, they're clueless in Wonderland, wander around the woods of financial planners and advice and YouTube and all this other stuff? What mistakes do they make?
And that's a really good point, because if it's self-directed, I'm assuming they have to have some level of education and some degree of sophistication when it comes to what they're investing in. Is that correct? I'm assuming. That's what I said. I'm assuming.
No, of course. And Robert, I think to your point about taking 3 companies public, that's complex. Wall Street's complex. Owning a home is not. People know about homes.
So what mistakes do people make?
Yeah, some other mistakes that I'll say we commonly see here, and some we can prevent and some we can't, is there's a retirement account vehicle known as a solo 401k. And think of it like a 401k that you would have for a company you work for, but it's for you as a self-employed individual. So if you're a self-employed individual, you can take advantage of higher contribution limits to a retirement plan that go beyond just an IRA contribution limit.
More tax reduction.
That's correct. Yes, yeah. Absolutely. Potentially, higher tax
in my
reduction.
Language, please. Jesus.
Right. And the challenge with that is not everybody qualifies for a self-directed solo 401k. And the IRS guidance is very specific that if you don't have active earned income, you can't contribute. You can't even have a self-directed solo 401k. And so a lot of investors that are looking at self-directed IRAs and 401ks, they'll mistakenly open up a self-directed solo 401k when they actually don't qualify. I'm seeing that more now than I ever have.
Yeah, that's a good point. So why would somebody go there? Oh, I got a solo self-directed IRA. What's the temptation? Lead us not into temptation.
Yeah. So, I've found a lot of investors will attend different seminars and conferences, and there might be a company there that's promoting a self-directed solo 401k, and that's the only type of account that they can offer. So they kind of get sucked into a sales pitch that is a little bit misleading. But the issue is they will have retirement money like an IRA or 401k, and they'll think, oh, I can just move this over to a self-directed solo 401k so that I can have check writing authority. Going back to that checkbook conversation that Tom was mentioning before, I think that was an important point for him to bring up. And then also people will look at the self-directed solo 401k as a good vehicle to go out and buy debt leverage real estate, which Tom also alluded to earlier, the difference between owning real estate with debt and owning real estate without debt in a retirement plan. So there are some bells and whistles, if you will, to a solo 401k that can make it really attractive to a real estate investor. But you have to make sure you're going about it the right way and you're structuring yourself properly. And I think we hit the nail on the head. All of us agree that we should have a tax advisor or CPA on the sidelines working with us in concert with us to make sure we plan appropriately. And that's what it comes down to. Self-directed IRA versus self-directed solo 401k. You just have to look at the pros and cons of both. And there are a number of organizations along with your CPA or tax advisor that can help you with that, along with our firm. And then you can make and evaluate and ensure that you're making a good decision going forward.
So what happens if somebody opens a checkbook IRA? What are some of the horror stories? Because otherwise it's a sales pitch there.
Yeah, so my team here, myself, I take phone calls every day and work through, the good, the bad, and the ugly, as you said, with self-directed solo 401ks and self-directed IRAs. And I recently talked to not a client, but it was a prospective client, and they were interested in unwinding their checkbook LLC IRA. They had been advised that there's great concern with this type of program, and they wanted to remove their assets and put it into a self-directed retirement account environment without the LLC. And ultimately what happened is they ended up finding themselves in an audit. And so their CPA advised them to hold put. They should not unwind the account because the IRS is going to audit that checkbook LLC IRA. I haven't heard back from this individual in terms of what the outcome was, but is
he in jail tonight?
Let me ask another question, because there's a lot of people selling IRAs and things. What are some of the scams or some of the lines, some of the sales pitches people will use that people need to be aware of?
Sure. I think it's a great question. What we tend to see is the accounts themselves as a vehicle. It's a government account, right? You can't hurt yourself with it, but the investments you make within it, certainly, as Robert said, there's an active role here, right? You have to do your diligence with the investments that you're going to put in. If it's something like gold or silver, there's certainly a lower level of that. To John's point, if somebody's offering an investment in, some startup company in Las Vegas, right? You're going to want to, if you were interested in doing something like that, certainly have to have that skill level to be able to do, the research and make sure that's the right investment for you. So we have that I think the biggest mistakes that we see, or where there is risk, certainly, is the investments that you choose to put inside the accounts.
Correct. And the reason I said we may live in interesting times, I'm pitched on NFT, Dogecoin, stable coins, crypto. I'm going, holy moly, Jesus. I mean, on top of that, you have how many 10,000 books of tax codes? And then you're going to sit there and say, I'm an expert on 10,000 pages of tax codes. Do you know what I mean? And so that's why the Rich Dad Company will make no recommendations, no endorsements. We invite people like you, because you came very highly endorsed by Lair Capital and their gold and silver company. Kim and I own tons of gold and silver, but I'll tell you something, ain't in my basement.
It's not under our mattress.
and if you come to my house, you'll meet my gun, not my dog, my gun. Because, these are the strangest times in world history. Would you guys agree with that?
Yes.
Unprecedented.
Unprecedented. We have never had such global debt in the history of the world. And this, global debt. Not only are you and I in debt, but the world's in debt. And when it goes all the way back to 71, when Nixon took the dollar off the gold standard and screwed the whole world, then the Fed and the Treasury helped it all out. So guys like you at Equity Trust are more important to go, at least go talk to you guys. That's really all I'm saying. How do you guys meet with your clients?
I could jump in here. So we have a team of, we call them IRA counselors, and we spend time with each individual prospective client before they make a decision to open up a self-directed IRA. That's one of the things that, and I learned from Jeff 15 years ago when I came into the business, is we have to meet with each individual. And it's in our mission statement that our mission is to help people make tax-free profits through education, innovation, and the commitment to understanding their individual needs. And Jeff's father, he pounded that into me from day one, is understanding their individual needs. So we would meet with an individual one-on-one over the telephone. We do business in all 50 states. And we would talk through their individual situation. What types of IRAs and 401ks do they have now? How can they move those into the right type of account, IRA versus 401k, and then allow them to make an informed decision. So, to your point, Robert, rather than promoting a specific concept, kind of putting all the cards out on the table and then allowing them to make the decision, because we can't give advice or recommendations. So we give them the information and they can make the decision. And we do have training and education. As a matter of fact, we did put together a specific course just for Rich Dad listeners. And there's 4 modules in that course. I'll just mention briefly the first 2 modules. The first one is called Diversifying Beyond the Stock Market. And so it's a video course that's recorded here in the virtual library that talks all about the various client investment examples and how investors are identifying alternative investments, how they're executing on those transactions, and how they're making them a tax-free or tax-deferred investment. And then the second module that we're giving to folks is what I call becoming the bank. And so I mentioned before my experiences and my wife's experiences with private lending. So these are loans secured by real estate. We just made a loan, as a matter of fact, 2 weeks ago, $100,000 loan to a real estate flipper at 6.5% interest, 13% per annum. And so whether the stock market's going up or going down, we have confidence that this asset is going to produce. And so I talk all about how I find borrowers, how I vet the transactions, the sample documents. We're putting that all in that module for listeners. For those that are interested, I'm sure we'll have it in the show notes, or they can go to goequitytrust.com/richdad, and they could pick up this course. It's free of charge, by the way. So this isn't something Kim and Robert, certainly out of respect for you guys and the Rich Dad viewers, this is something that we put together for your listeners only, and they can pick this up free of charge.
Thank you. Again, we don't endorse it, but we do support education, even bad education, because, you know, I've gone to those seminars and I've stood on stage and with a whole bunch of other speakers, and the first thing I did after I got off the stage was take a shower. I mean,
well, Robert, I couldn't agree with you more. And, coming up in 2 more years, we'll hit 50 years at Equity Trust and our predecessors, and to be in business that long, you have to do right by your customers. And I think you're saying exactly what listeners need to do: educate themselves.
Yeah, be aware, because I don't think you can educate yourself. You just have to know who you can talk to. Most importantly right now, and be aware, there's many pitfalls out there. Again, as my rich dad said, there's a million ways to financial heaven and billions of ways to financial hell. And I'm afraid billions are going to go to financial hell in a few more years. And so that's why I thank you guys for what you do. Again, Rich Dad is only an educational company. We make no recommendations. So gentlemen, how do they get in touch with Equity Trust one more time?
So folks can go to goequitytrust.com/richdad. Again, that's goequitytrust.com/richdad. I'm sure it'll be in the show notes as well. And they can call us directly and they can pick up the free education training that we're offering.
Okay. Well, thank you for offering that service, you guys, and good luck to you. And may we live in interesting times.
Thank you, John. Thank you, Jeff. Appreciate it. Keep
Thank
educating
you.
people.
And we at Rich Dad, we'll be right back. Thanks, you guys. Thank you very much. Hello, Robert Kiyosaki. And I want to thank those guys at Equity Trust. It was a fantastic program, and it was a very good idea to have our real advisor for the last 30,000 years, Tom Wheelwright. And if you've ever been to Tom's office, his CP office, it's bigger than the National Library on tax code. And so anybody thinks they know taxes, give me an effing break. I mean, that's all that Tom studies. Right?
But yeah, and that was a perfect example of how we do talk with Tom about looking at different investment vehicles.
Before we invest.
Yeah, so we would never invest with Equity Trust unless we had brought Tom in and Tom looked at the pros and cons of our portfolio and does what works, what doesn't work, and that's what you really need.
And Tom has a whole series of books starting with Tax-Free Wealth, because I would read Tom's book, Tax-Free Wealth, before you hire your advisor, because there's many tax advisors out there, crooks, conmen, and idiots. And the other thing that's really dangerous about today is many of the people entering this whole financial services markets haven't been through a depression. And I think we're heading for a depression. So that's why you really don't want to sit there and everything's happy days are here again and the stock market is going to keep going up, because I don't think it will. But if it does, fine. If it doesn't, fine. But you better be prepared for it. Sarah, what was your point of view on this whole interview?
Well, one, give all the credit to Kim for that genius invitation to invite Tom on the show, because I thought that was a perfect example of the importance of an advisor or having a team, right? Because if you didn't have somebody like Tom,
we would have no idea what they're talking about.
People don't even have $1,000. How are they going to get?
Well, you're right. But I also wanted to thank you two for doing this show, or, like approving this guest, because there are a lot of people who still have 401ks, IRAs. And I think this was an interesting perspective for us to offer. We always talk about we're an education company. So I'm glad that we did this show. I'm even more pleased that Tom was able to join.
Right. And if you have 401k or an IRA, don't do anything until you and you figure things out for yourself.
Yeah, I think that's the biggest lesson is we're not here to endorse or say do this, but this is opening the door for some education.
And the other thing that I heard today is, I mean, you look at any investment, any type of vehicle, there's pros and there's cons. Yep. And you got to look at the pros and the cons. So if somebody's trying to sell you something and they're only telling you the good, I would run because you know there's a downside.
Yeah. So, I mean, and I've stood on the stage. I mean, I leave on Thursday to stand on the stage with a whole bunch of other speakers. And like oftentimes some of these characters stand up and they're famous. They're famous. And every time I shake hands with them, I got to count my fingers. You know what I mean?
There's some good.
Not any of the ones you're going to be with this weekend.
Not this weekend. Not this weekend.
So I just want to reiterate, Rich Dad is an education company. We don't make endorsements or recommendations or any of that. We do recommend, though, that you have great advisors. And with a Rich Dad advisory team, like we want to learn about real estate, we have Kenny, right? Yep. Taxes is Tom. Corporations, Garrett Sutton. And Andy Tanner for the stock market. And John McGregor for retirement plans. Not retirement plans, but how he doesn't like them either.
How to protect your wealth.
So education is the best defense. And I'll say this, ladies and gentlemen, this is the strangest time I've ever seen. When Kim and I, we started this company, we knew it was going to get strange, but not this strange.
Not this strange. Who could have ever predicted this?
And, I was just down on the southern border of Arizona, and President Biden and our border princess, Kamala Harris, the border is wide open. These guys are just pouring through. And I'm going, why are they doing this? Why are they doing this? And it's a big, I posted some pictures. These high school kids, they rent these vans, 8-passenger vans, and they're charging $1,000 per immigrant to climb in the van so they can drive them north. And the police can't and don't do anything. Why is this happening? I don't know. So anyway, these are the strangest times. The stock market's at an all-time high. That's why I wrote this book here, Who Stole My Pension? Because my mom and dad always said, oh, get a job with a good pension. Well, even that's gone today. Those are called defined benefit pension plans. IRAs and 401ks are defined contribution pension plans, and they all came about in 1974. So we're paying the price for it today. So thank you for listening to The Rich Dad Show. Please keep getting educated, and no, don't listen to an idiot, so don't believe a word I say, because you'd be much better off that way. Any final words, Kim?
No. The most important thing for me is you look at the three sides of the coin, the heads, the tails, and the edge. Look at all sides of the coin on any investment vehicle.
Yeah, and be careful because, I don't make any recommendations because I don't want to be in a jail cell dancing the hula for some guy. So I always have great accountants and great attorneys around me to make sure I just don't go to jail. That's the biggest thing, and lose all my money. So thank you for listening to the Rich Dad Radio Show, and have a good life.